I did it again, just like last week. I didn't press go live. Here we are. I literally did like the 2-minute intro, never pressed go live. So I thought I was live. I wasn't. Anyhow, technology is not my strong suit. Let me know that you can at least hear me, because that was what I did 2 weeks ago, is I had it muted so nobody could hear me. Usually on Mondays when I'm doing this, I've just got finished recording what is going to come out Tuesday. So that's always top of mind. So I'll share with you guys the cash buyer video that I just recorded. Thanks, Joey. Glad to see you can hear me. And then we'll just talk about market in general, what's going on in the real estate market. Because I think that while things are crazy in a lot of senses, we've got some good stuff on the horizon, is my hope. But the first thing I'll address is this video that I made coming out tomorrow talking about cash buyers. My videos are always provoked by something I see on TV, because I'm Googling just like you're Googling. I'm watching YouTube and TV and financial news just like anybody who's watching this is. And I saw this thing where it talked about cash buyers taking over, and it had like an infographic, like 1 in 5 is a cash buyer, and then it ticked to 1 in 4 and ticked to 1 in 3. It showed Atlanta 70% cash buyers. It showed Arizona 40% plus. I don't even know what city it was in Arizona. Then I go to my old trusted friend Google to see what the internet is saying. Realty Track says 40% of buyers are cash buyers. Goldman Sachs says 57% are cash buyers. And I'm like, there's no way this stuff can be true. It's just not the case, right? Sacramento, where I'm at, highly competitive market. I know the stats, and I'll be the first to admit, I'm seeing, hearing, and feeling the stuff from real estate agent partners, from consumers I'm talking to, from the work I do every single day. I'm not necessarily diving deep into stats, but there's certain people I like and trust. Ryan Lundquist, Sacramento Appraisal Blog, being one. He's got the stats from last month. About 16% Sacramento County buyers during that month were cash buyers. So if we're sub 20%, I find it nearly impossible to believe that there's markets out there that have 40% cash buyers. Just not the case, right? And I think the ultimate lesson, or at least my thought, is that it doesn't take cash to get an offer accepted. I had multiple conversations this weekend. I had a buyer who I talked to their father. I had a buyer, another one the day before, that had a similar situation where they're like, well, since it's so hard, I'll have dad buy cash, or in another case, I'll have my aunt buy cash. We'll work out something on the back end where I pay them back. That's the only way my offer is going to get accepted. In Sacramento, 84% of the buyers got their offers accepted with financing. So it's not impossible. It's what I said in my video, what I'll preach to realtors, what I'll preach to you. A great realtor and a great lender that can give the sell side certainty is what you need to get your offer accepted. That, you need to write a strong offer. It meets all the things that the seller's looking for, not just price, but terms, rent back, all the other stuff. Anyhow, I think that is probably overblown, and probably something that's like spreading some fear, uncertainty, and doubt where it's not really justified, right? Do cash buyers make up a certain percentage of the market? Yes. Is it such a high percentage that people who don't buy cash have no chance? No. So anyhow, let's jump into some questions. It sounds like my buddy Alex is here for a market update. Good to see you, Alex. I'll do all I can to shed some light on what I'm seeing, feeling, and hearing. Miss Taylor's here for the same. Expert opinion on the hiked interest rates and the 2022 future for entry-level home buyers. You guys know I saw Freddie Mac shared a stat. I should be sharing this on my socials, where for the last 30 plus years, they tracked how much rates had moved in 3 months. And in general, rates don't move a lot. So maybe like 0.1, 0.2, 0.3 over a 3-month period. In March, this year, like right now, the last 3-month period, we've seen 1.31% increase in rates. So from like 3.7 to 5% rounding in 3 months. That's the biggest interest rate increase, biggest 3-month interest rate increase we've seen since 1994. 94 was 28 years ago. So it's pretty drastic. And, truth be told, I think that it takes a little bit before buyer sentiment changes, before we start to see demand slow. But I've had multiple conversations with multiple agents and also with buyers that we're working with where people are backing off. If you're in a position where you've got great income, you're very well qualified, and your payment goes from $2,400 to $2,600, and it's, not anything you're like terribly concerned about, then you're fine. All the benefits of home ownership still apply. It's going to appreciate over time. You're going to have the, benefit of debt pay down as you pay that thing down over time. No one's going to be able to raise your rent. You paint your walls whatever color you want. You're going to have some certainty in where you're going to live next year and the year after and where your kids are going to go to school. So all that stuff still applies, but it's really the toughest for the entry-level buyers who were going to be able to buy something at $400,000, really stretching themselves to the max. And they were going to do it. They were going to make it work. Even though that was at the very top end of their budget, qualifying wise. And after 3 months, 6 months, 9 months, 12 months, that $400,000 house became $450,000, $475,000, and the interest rate went up. And there's a difference between unwilling and unable. Some people will be unwilling to pay an extra $200 or $300 a month. If you're unable, you just can't buy, right? And so what I think I'm looking at, and a lot of other folks are looking at, is on one side, we've got willing and able. On the other side, we've got the supply, right? The supply is really small. Willing and able is huge, but shrinking, right? The amount of qualified buyers on the demand side is going down. Anybody who tells you otherwise is out of their mind, right? There's certain people that qualified last year that don't qualify this year. They make the same amount of money, but homes are 15% more expensive and rates are up 1.5%. They do not qualify anymore, right? So that is going to quell demand. There's nobody in their right mind, even in the mortgage profession or the real estate profession, that's going to say, we've got the same amount of demand as we did last year. And demand's not going to be affected by these rates. Out of their mind, right? The question becomes, how much does demand pull back? And what does supply do? I have two feelings about supply. I have a feeling that if demand ceases while we get a little bit of an increase in supply over the spring, then it's going to look good for buyers. It's going to be flat as far as appreciation goes. It's going to be 3 to 5 offers, and it's going to just feel a lot easier to get an offer accepted. The problem is a lot of people are staying in their homes longer. Like that, whatever word they use to describe how long somebody stays. Oh, what does that word start with? A T? Anyhow, it's increasing. It was under 10 years, then it went to 10. I don't know what I've seen it at recently, but like people are just staying in their homes longer. They've got a 2.6% interest rate. They're happy. It used to be one of those things where in a decreasing rate environment, you could sell your house, take your equity, buy forward, get a cheaper interest rate, and only pay $200 more per month for a house that cost $500,000 more because you had the equity and you had a lower interest rate. Now people are looking at it 10-year. Thanks, Miss Taylor. 10-year for sure. Now people are looking at it and to buy a house that's only slightly more expensive, 200, 250 more maybe, with all the equity they've got, throwing it all towards the new house, they're going to pay $1,000 more per month. Trust me, I've ran scenario after scenario. So yeah, it'll be interesting to see. And I think that as much as I'm optimistic about more inventory coming, and trust me, like it's already coming, which it always does in spring. We shouldn't be surprised by more inventory. It's a matter of how much we're going to get. It's going to be how much and how soon. A lot of what I see today, I saw something along the lines of monthly inventory of 1.5 million homes, which is like pre-pandemic, like 2019 levels. Maybe it was Zillow that predicted by 2024, we'll see that inventory number again. Other people say 2023. Us getting it this year, I don't think so. And that is why hoping for a 10, 15, 20%, even a 5% correction in prices in 2022, wishful thinking. Home prices aren't coming down. I think that what I would advise clients, and it was something I was thinking about this morning, is you buy when you're willing and able, and that always holds true. But also, don't pay points for an interest rate of like 4.75. You know, you might be able to get 4.5 or 4.75 for a point or two. If you can get 5%, pay no points, and you qualify, you get into the house. If we go through a recession and we do 5 or 6 rate hikes, guess what happens after that? Now the Fed has got ammunition. They've got some levers they can pull. We go into a recession, the economy starts hurting, unemployment goes up. The Fed does it again. They pull out the big guns again. They start firing off and pull interest rates back down, right? And so I don't think it's advisable for anybody in today's market to pay points, right? Take the rate that's at par or maybe paying 0.5 point. Know that that's like your worst case scenario. If you got to stay in it, you stay in it. But if something appears in 2 years or 3 years, or maybe even shorter time frame than that, where you can refinance it into a 3.99, you refinance it. But you don't pay up front right now for a 4.5 because all that money is sunk cost, right? Once it's gone, it's gone. And that's what happened with some people that were paying for interest rates, and then they saw rates go down 1%. And then they called in 2020 and they're like, hey, I want to do a refinance, go from 3.5 to 2.625. They shouldn't have paid money for that 3.5. They should have taken the 3.75, wrote it for a year, and then refinanced in the 2.625. But anyhow, that's a little bit too far down those tracks. All right, Austin 250. I like it, man. 9-month at 3.5 back in October is the only factor to keep that locked in, closing on time. Yes, if you've got a lock, you are solid. Trust me when I tell you I am knocking on wood. I am not a man that prays a lot, but for you, I will. You want to close this thing on time because most lenders, like, you're at the mercy of the builder, right? If you blow this lock, you're going to be subject to today's pricing, worst case pricing, they call it. And it's up like 5%. So if you go, you know, a week or 2 weeks or a month, which builders are seeing delays of months, this rate could disappear. I hope for your sake, no, right? I would be there. I'd show up with a friggin' tool belt, bro, and a hammer. I'd be helping them finish this thing so you can get that 3.5 locked in. Because if you blow that lock, it'll be an expensive, you know, let's say you borrowed 500 grand and 3.5 to 5%, like whatever that spread is, 600, 800 basis point difference to get that same rate. It's like a 40 grand cost or something. Not something you want to do. Yeah, I get you, Miss Taylor. It's the rate and the record high home prices. I totally get it. And trust me when I tell you, I've got, you know, all I do is work on the buy side. with buyers, right? I have no vested interest in sellers selling for more, record prices, any of that. All I want to do is be able to get people into homes. So when I've got 80, 90, 100 people who are pre-approved and actively looking and shopping, and only a small percentage of them get offers accepted, and it's tough, and home prices keep going up. Trust me, I'm with you there. On knowing it's hard. All right, let me get to some of these questions. Basilio, do you know if my wife needs to declare all properties that are under my name if she's applying for a loan? Does she need to declare these assets to the lender? Ping me on the side, matt@mtmg.com. It's going to depend on loan type. It's going to depend on how you guys show up on title, even the state, right? Like somebody was questioning me about a non-borrowing spouse's debts on the FHA stuff, and that's in community property states. Shoot me a message on the side, Basilio, because I want to make sure I answer it correctly. Matt, M-A-T-T, @mtmg.com. Happy to help you out. Where'd I go? There it is. Shoot me that question, man. I'll get you squared away, Basilio, and I'll make sure I answer it correct and specific to your plan. All right, Diana, thanks for joining. Appreciate you being here. What's a good DTI to qualify for conventional owner occupied with 5% down? Also, how is rent for current home calculated? If I could rent current home for $1,500, but got to pay $1,100 for a loan, $300 for utilities. So the first question, DTI for a 5% down owner occupied conventional. It's like multifaceted, right? Where it depends on your credit score, depends on other factors, but we plug it in. The automated system gives us an approve eligible or not, right? And I can just tell you rough figures. You'd want to have your debt to income ratio under 40% for your front end ratio and under 45 for your back end ratio. Could it go higher? Certainly, but shoot for that. And for anybody who's listening, it's like, what does front end versus back end mean? If you've got $8,000 in income, and I'm telling you your front end needs to be below 40%, take that 8,000, multiply it by 40%, you'll get 3,200. The front end is just the new mortgage payment, the housing payment of the subject property that you're buying. So whenever you hear front end ratio mentioned, the front end ratio is the mortgage that you're applying for on the subject property that you're buying versus your income, right? And that's generally, you want it under 40%. Could you get approved at 41 or 42? Of course you could. Let's just, for rounding purposes, say under 40. Back end ratio under 45. All the other debts on top of that, car payment, student loans, all that, you don't want it to exceed 45%, right? So in this case, there wouldn't be a lot of room for a lot of other debt. As far as calculating your rent on the current home, if you're going to leave and rent out the house you're leaving, you can use departing rental income. That $1,500 rent would be multiplied by 75%. They take that 75% factor and 375, what is that? 1125? 1125 you get to use to offset your mortgage payment. In this case, you say you got $1,100 for a loan on there. That 1125 is going to offset it. You're going to be good there. The utilities for you want to make sure that you're not losing money every month. Otherwise, you just sell the friggin' thing, right? But we're not going to take it into consideration. Utilities won't show up on a credit report. They're not going to be something that we take into consideration from a debt to income standpoint from a lender. Hopefully that helps. All right. Another question. I have an FHA loan before I got married. I'm married now. Can my husband have an FHA loan under his name and I'm on the loan to qualify? Or do I need to refinance? This is a great question, and I'm waiting for the wheels to turn up here. I literally made a YouTube video called "Can I Get 2 FHA Loans?" or FHA loan exceptions, something like that. Because there are exceptions where you have a first FHA loan, your husband's not on it, he buys the new one, and you're the co-borrowing spouse. I'm fairly certain you can do it that way. If you want, ping me and I'll make sure. As fast as I learn information, I forget it, right? But there's different ways. Like if you bought a house with somebody else with the FHA, if you moved out and they retained that FHA loan in their name, you could buy forward another FHA loan. There's a bunch of different exceptions where you certainly could do that. I think in this case, since he doesn't have an FHA loan, and he's not tied to that first one, he could, and you could be a co-borrower on that one moving forward. I'd want to confirm though, just like a lot of things in lending, right? Based on experience, I'm saying me thinks, but me tends to verify. All right, last question, Diana. Ooh, you came prepared today with a list of questions. Happy to help. Do you have any tax preparer CPA referrals? I haven't done my taxes. Are you in Sacramento? Are you in California? I don't know anybody who works in other states per se, but if it's in California, can probably help you out with a referral. Go ahead, shoot me an email there, and I'll connect you with who I got, matt@mtmg.com. Happy to help. If anybody's looking to get pre-approved too, while I'm putting up these banners, greatmortgagebroker.com. It's like 6 questions: name, email, phone, looking to buy, looking to refinance, what area you're in. Let us know. We'll get back to you. I didn't even mean to put the pinky up. Look at that, pinky up. That's when you know you're doing it big. When you got the pinky up. All right, closing 429. Congrats. New build. 30-year fixed locked at 5.3 on a new build that we contracted back in August with very good credit. We're in for at least 20 years and we'll look to refi in 3 to 5 years. Okay. Congrats on the new build. Hopefully they get that thing done and you are closing the end of April. Not sure if there's a question in there, but you know, if you're using the builder's lender, hopefully they're offering incentives. My experience is when a builder's lender is doing the deal, it's more expensive. They can offset it by giving you $5,000 in credit or $7,500 in credit. But in general, the mortgage companies that are either owned by the builder or partner with the builder are more expensive. So being that you're a month out still and that you're a consumer free to use whatever lender you want, you might want to get a second opinion. I know a great lender, Sean Grapevine, U Mortgage, Georgia, who could just basically look at your scenario and tell you if you can do better. If you go to greatmortgagebroker.com and fill out that form, we'll connect you with Sean. He's with U Mortgage. He's our Georgia guy, especially on the purchase stuff. I'm going to refer you to him to take good care of you. So let me know. We'd be happy to help. At least take a look at it, right? If we've got 4.875 versus their 5.3, depending on how much you're financing, it could be, you know, significant amount of money. Eddie, I feel you, man. The move up is getting tougher. And for all those who are going to say Matt only talks, you know, that the sun is shining and only the good parts about real estate because he wants to get more mortgages and he's just trying to get more business, I will tell you that I've talked more people out of moving up this year than all the other years in mortgage combined. Because for a lot of people, it just doesn't make sense right now. There's people that have legitimate reasons, right? And there's people that like it's not going to affect them. And so, you know, all good, go do your thing. But there's other people that are like, I'm going to sell for $775 in order to get something I really like. It's going to be $1 million. I'm going to take this equity. I'm going to throw it towards the $1 million. And you look at it, you're like an $800 difference in payment or $1,000 difference in payment. $775 to $1 million isn't that big of an upgrade, right? Like, do you want to pay an extra $1,000 a month for one extra room? Go through as difficult as it is to get an offer accepted, try to time a sale and a purchase. It's not for everybody. Oh, that's a great question, Nicole. My tenants are paying me cash. Is that an issue for underwriting? Underwriters, lenders in general, what we're looking at is the tax returns. So you got a Schedule E, schedule of real estate owned. You've got your property on there. You've got rents received. You've got taxes and insurance and repairs and expenses. However you file your taxes, that's what we're looking at. If you cheat in the tax man, Nicole, they're going to come find you. They're going to be upset. They're going to try to get their money. But rents received, you just report it, right? They're not looking to see if, like, was it cash? Was it checks? Tenant pay by, NFTs and Bitcoin? As long as you're filing it on your tax return, you good. Once pre-approved to buy, is it a bad move to open a HELOC on your current home to use in as emergency reserves emergency fund? I'm assuming it's a bad move, like buying a new car when buying a home. This is a great question, Alex, and you're spot on, where you don't want to do anything that messes with your credit profile. Taking out a HELOC where you've got $100,000 in, funds available definitely affects your credit profile. And what happens is, since you've got access to the money, the lender is going to look at it the same way they look at it if you had $100,000 borrowed, right? Because literally they could lend you whatever money they're going to lend you, and you've got a 37 or 44 debt ratio. If you've got access to 100 that you could pull the very next day and have a $700 payment on, they'll be lending to you at a much riskier, like, debt to income ratio, right? So they're just going to factor that in from the beginning, right? So don't do that, especially since you're working with the best team in town and you don't want us to have to call and scold you. You are right that you can have it if it's more than 100 miles apart, right? And you're moving from LA to Sacramento, you got a FHA loan down in LA, and now you're moving up here. And trust me, FHA, like, on that 100 miles is a real deal. I had somebody moving 88 miles, Sacramento, the Bay Area. And FHA said, no, can do. But in this specific case, we're able to do it because it was daughter and father both got an FHA loan together. Daughter was leaving to the Bay Area, only 88 miles, so it wasn't 100 miles, but father was staying in the home. So one of the borrowers on the loan was maintaining it as his primary. Daughter was moving forward. She was able to get another FHA loan. So success story. Math and Mortgage Guy team. It was 2018-ish. Good for me for remembering that. All right. Yun Pak, thanks for joining. Appreciate the questions. Looking to purchase third investment property using HELOC on your first property. If I use HELOC for down payment, will this offset my DTI, thus difficult to close? You're going to want to take the HELOC and factor that in prior to getting pre-approved for the investment property. Because like I was telling Alex, if you've got access to the money, or you take it like when you're in process of buying, or whenever you take it, like, the lender's going to want to take into account that debt and that payment on that debt. All right. Kevin Quinta TV. Thanks for joining, brother. This guy's got massive following on Instagram. You got to go check him out. He's a pretty funny dude. Self-employed and a pre-approval process with cosigner. Can accepting 3 months of COVID rent relief ruin securing a loan? Never late on rent by applied a year ago, just deposited into landlord's bank. It shouldn't. So you received rent relief, and my guess is that whatever pre-approval process you're going through, they're asking for like proof of rent, some sort of like 12 months of rent. Or you're just getting that rent right now. You should be fine. I haven't, gosh, you know what, Kevin? This is where I got to be like, you know what? Let's not get you, I think. Let's get you for sure. It's only going to come up if they need proof of rent. So, lucky for you, I've got fantastic operations, former underwriters at the #1 wholesale lender in the country. I'm going to send them that specific scenario. I can ping you on Instagram. I can send you an email. If you want to fire me an email at matt@mtmg.com, do that. Or I can just send you the message on Instagram. But I'm going to find out for sure. Pretending like I know the answer for sure, probably not the best look. Admitting that I think it won't be a problem, but I'm going to double check for you is probably the best way to go here. So, yeah, I think you'll be fine. I'm going to leave myself a note. Kevin, rent relief. So we'll see if that causes an issue. All right. I'll get back to you, brother. Miss Crystal Myers, thanks for joining. Information on USDA loans and how long do they normally take to close? Sure. USDA loans, for anybody who's wondering, are loans that have a lot of great facets to them. They're 100% financing. They're restricted, though. You have to be in the income guidelines, so you can't make over a certain amount, and it has to be in a rural area. Like you can't buy in the middle of the city using USDA loan. There's actually a cool feature on USDA.gov, I think is the website, their website, where you just go and you type in an address and it'll tell you whether or not it's USDA eligible. So if you qualify with your income and it's eligible property, meaning it's rural enough for them. And trust me, like there's some areas near us where it doesn't feel very rural to me, but it counts. That word rural is a hard word, so forgive me. But yeah, these loans generally, Crystal, close within 30 days. Income restricted, where the home is restricted. The biggest issue we've come up against is that the debt to income ratios are pretty strict, meaning you have to have enough income to qualify for our debt to income ratio to work, but you can't have too much income because then you don't qualify for the program. And it's got to be in a rural area, which in California, the thing that really messes us up is you get rural, you get to a place where like it's a fire zone and you've got $4,000 a year in hazard insurance to buy fire insurance plus the California Fair Plan and whatever else is required for that area. So I would take a look at the area you're trying to buy. Start, of course, like everybody should, getting yourself pre-approved with the lender, making sure, one, you qualify for this type of loan because your income's got to be in the right range. And then you can start looking at certain properties, good lenders who have good relationships with good insurance brokers. I've got clients that are putting out offers and I'm hitting the broker with like, how much is it going to cost for the insurance plus the California Fair Plan on this property? I just did that yesterday where we sent out a quote, what the loan's going to look like based on $344 a month for the insurance it was going to take on this rural property. So hopefully that's helpful. As always, Crystal, greatmortgagebroker.com. Let us know where you're at, how we can help. If not us, just find a local broker you like and trust. At all costs, avoid the rocket. Hola, Mateo. Hola, Albundi. Yeah, shoot me an email, Kevin, Matt, M-A-T-T, MTM at mtmg.com. I'll make sure to get it. And yeah, YouTube will cut down your question, but give me all the deets you can and we'll get you. I'll literally take that, give it to an underwriter. Underwriter will respond to me within 24 hours. You'll know for sure. And then you'll be able to sleep easier at night, hopefully. Won't have night terrors from trying to get an offer accepted in this market is the hope. All right, Al Bundy. What's the minimum down payment for a DSCR loan? For anybody who's unfamiliar, debt service coverage ratio loan. The most simple version of all that acronym talk is you've got rents that cover your payment. Your payment's $1,900, the rent's $2,000. If you put 20% down and you've got good credit, you're going to be eligible for one of these investor loans, debt service coverage ratio loans. Most all lenders I work with, Al, require 20%. Some even require 25%. I don't know if I've seen anybody at 15%, but truth be told, like anybody looking to put less down, you want to have 20%. Oh, this is always the question. All right. How high do I think it'll go? Let's look at what it looks like right now. It's the only time I share the screen is to show this chart, I think. Ba-bam, ba-bam. All right, guys. Biggest. Is it there? The biggest 90-day increase of all time is upon us. Where are we at? What was 90 days ago? End of January? So here we were at 3.6. It was higher. It wasn't sub 3 anymore. People are like, it's all right. It's going to get sub 3 again. Dun, dun, dun. Dun, dun, dun. All this talk about the Feds increasing the Fed funds rate. All this talk about running mortgage-backed securities off their balance sheet. 495. This is like a nationwide average. The what do they call it? A survey of the 30-year fixed rate. You know, some banks and lenders might be higher. Some brokers might be lower. I think this, when they do this before, they'd have it like be a 0.4 cost. But whatever the case, it's about 5% for a 30-year fixed. If your credit's bad, it's probably over 5%. If your credit's great, it's likely under. If you're buying an investment property, if you're doing something else like a manufactured, you're in the fives. But where do I think it's going to go by the end of the year? I feel like a lot of the Fed's actions have been talked about enough to where we 5.5%. Final answer. 5.5. Is it just the end of the first quarter? Yeah. I think 5.5. And then I think the Fed next year is able to throttle back rates if we start feeling a recession, which a lot of folks think we will. A lot of folks that are way smarter than me. So, yeah, that's my best guess. I don't know what I base that on. I think I based on the fact that the Fed is going to do a lot more with monetary policy this year that has upward pressure on rates, but they've already forecasted most of it. Like we know if the Fed does like a 0.5 increase on the next two Fed meetings, it won't be that big of a surprise. The market moves most when there's something that happens that they weren't expecting. We're expecting that to happen. We're expecting the Fed start letting their balance sheet run off. We're expecting the Fed to do 4 or 5 rate increases the rest of the year. If they didn't, that'd be the surprise. This is a great question, Matt. I think that the supply thing is something that people are really undervaluing. The fact that like there's so little supply that even if demand is quelled, even if these rate hikes cause layoffs and businesses to lose value and other things recessionary type things to happen with enough buyers to continue to buy, even with demand down 60%, call it. Let's say after people kind of digest all this rate increase and what it means to prices and whatnot, like there's a 60% decrease in demand. I still think that demand supply is not like it's not like supply all of a sudden, is 3x demand and we've got some sort of buyer's market. We're just in such an imbalance that it's only going to cause things to flatten. It's too far out of balance for it to reverse course to be 6 months worth of supply, buyer's market, home prices going down 10%, 20%. I don't see it. Monthly payment society. Price of the home matters. Price of the monthly payment matters more. Yeah, and I think that's the thing is that like with inflation, we're seeing rent prices move up quite a bit as well. And so to Joey's point, like, yes, $200, $300, $400 increase to your monthly payment as a buyer, but your alternative, which is renting, since everybody needs a roof over their head, has gone up the same amount. So you're not saying like, screw this home buying thing. It's $400 more expensive. I'm going to go rent. Rents have moved up right alongside. So, yeah, it's tough. Financial Literacy Week. Thanks for bringing this up, Joey. Today is the start of Financial Literacy Week. On Friday, I'm going to do a session on refinancing. I am not very popular with some mortgage folks. I tell a lot of people refinancing doesn't make sense for them. I can tell you who doesn't is Rocket Mortgage, who's doing more refinances for sub 680 credit scores than anybody on the planet by a long shot. I think those cash out refinances to those borrowers is a big disservice to them. I think they're stripping away their home equity when these folks don't even know what they're getting themselves into. But another point for another video, right? If anybody wants to check out Financial Literacy Week, I was trying to find my specific link. Let me see. Let me find it real quick. If I was smart, I would have it on here. Come on, Mateo. That might be it. Is my computer that's lagging? I think that's the link. https://co.umortgage. I think we got thousands of people attending Financial Literacy Week, Joey, and I'm super stoked about it because, as you know, and I know, and everybody knows, I almost left the site to go to Financial Literacy Week. That wouldn't have been good. Yeah, there's like so many. I'm going to share this link, and I apologize for not being very good at multitasking to talk and do this, but I think this is important enough to share with folks. Mother, co.umortgage. Is that a capital O? There we go. Man, I am the very best, let me tell you. Copy. All right, the link's coming, folks. Here it comes. I am going to put it in the comments. I could have had Joey put it in the comments a lot quicker than me, huh? There we go. Go check it out. It runs all week through Sunday. And it's free, of course. Share with anybody who could use financial literacy, which is everybody, right? Mother, brother, sister, cousin, daughter, son, aunt, uncle. Like, I'll go through this thing real quick. Here's what I should do. Let's do this. Let's give financial literacy a little bit of a plug. It's that important. This is Financial Literacy Week. The first time we're doing this at U Mortgage. Starts today. All kinds of great stuff. Here's what's on the docket for today. Basics of financial health, budgeting and financial habits, designing your career with money in mind. Tomorrow, credit and credit cards, interest versus APR, navigating student loans. And see, we got like Grad Fin and all these guest speakers coming in to talk about this stuff. We got financial planning and investing and insurance with Northwestern Mutual, crypto and blockchain, NFTs. Mass Mutual's doing financial concerns of business owners, understanding debt, taxes, and personal W-2s. Our buddies over at Debt Does Deals is doing a cool one on a different perspective on debt. Friday, we've got first-time home buyers, second-time home buyers. I think one or both of these, my buddy Kyle Kohler, investing in real estate. My buddy Jimmy, who owns a bunch of stuff in Utah. VA loans might be Jimmy as well. Refinancing, yours truly. I'm going to do that segment, and then some more courses over the weekend. So check that out. Obviously, the price is right. It's free, and financial literacy is something that everybody, and I mean everybody, myself included, could use some more of. Tell your kids they got to get on there and do 2 hours, right? It's part of their weekly chores. Thank you for the kind words, Miss Crystal Myers. Much appreciated. Thank you for stopping by. Yeah, Alex, I guess the thing you want to avoid is, like, I've seen some people, what do they say? Try to catch a falling knife. Like, you don't want to delay purchasing while you're trying to save. Like, the ones that I really, really feel for are ones that have 5%. They're like, listen, I'm going to save for another 2.5 years because Dave Ramsey told me I got to have 20%. I got to do a 15-year loan. And, they buy 2.5 years later and the house costs them an extra $150,000. You don't want to do that. But I mean, I get it. You definitely want to be financially responsible, have a little bit in savings. You don't want to throw every last cent you have towards a home purchase, but you also, it's a fine balance. You don't want to try to wait and save yourself into something if while you're saving rates go to 5.5 and the house you want is another $80,000. Alex is all in on getting a house though, man. He's thinking about selling his wife's car. Yeah, you guys can carpool. I could let you borrow my electric bike. You can cruise to and from work on that thing. Yeah, save gas money too. Look at that, man. You'll save the monthly gas money. You'll have that money from the sale of the car. Used cars too. Gosh, my niece just bought like a 2003 Honda Civic, 20-year-old Civic, $6,000. You can get top dollar for used car right now. So maybe you want to sell. I don't know. All right, Yeshi, this is a great question. I don't know if anybody can answer it, but I will do my best. How do you know we are paying the right amount for the house you buy? I don't think the home price, the interest rate, any of that stuff should matter to you. What should matter to Yeshi is your current financial situation. And this is what you should do during the pre-approval process is you get your application in, you get your docs in, you see what the home looks like based on how much down payment you have, based on where you're looking. Let's call it 400,000 with 5% down. I've got to make up numbers that might not apply to Sacramento because we're talking to folks nationwide. But let's say that purchase price with that down payment, with your taxes and insurance and mortgage insurance all in, you've got a $2,200 a month mortgage payment. If your current situation says $2,200 is something I can afford, 30-year fixed payment, I've got a stable job, I've got pay that can support that monthly payment, that's when you know it's correct. Not like timing the market, timing interest rates, making sure that I paid, 400 versus 415 or 385. Nobody looks back and goes, oh man, glad I got that house for 345. If I would have paid 355, terrible. Wouldn't have done it, right? Like most people, especially right now, like shit, I wish I would have offered another 20 grand on that place I offered on last August. Because now the thing is $60,000 more expensive. And we might not always, I shouldn't even say we might not. We're not always going to be in a market that's appreciating as much as this one is. But still, 10 years from now, 15 years from now, 20 years from now, if this is a long-term play for you, you're going to stay in this house as your primary, you don't care what you paid for it. I think the monthly payment that fits in your budget and it's a house in the neighborhood you want to live in for now is what matters, right? That's when you know. And I don't know. I'm not going to tell you. I'm just going to give you the options and pre-approve you for what you're pre-approved for and show you what it looks like at 375, at 400, 425, at 5% down, at 10% down. Whatever you're able to do and you want to see, that's what the lender's going to show you. And then you decide whether it fits in your budget. All right, Sophia. Man, I'm seeing more and more people with these new builds that are ways a ways out, man. They're taking a long time to close these puppies. Why in the world is my click? I feel like my computer's tripping. Anyhow, likely to close on a new build in December. No rate lock available. If rates come down, when can I or when should I refi if we close at 5.5 or 6? What's worth a refi and when can one refi? That's a great question. And I think what you should really be sure of is if you can do a 180-day, you can do a 90-day, you probably want to look at those. I talked to someone today who's like a year out from buying, and they're probably going to wait until they're 90 days out. Like 180-day locks right now are expensive. A lot of lenders are charging $5.5 to lock it for 180 days, which you might not want to do because rates shouldn't be that high. I don't know. I probably shouldn't say that. Rates have been smacking everybody in the face nowadays. So in regards to refinance, depending on how much you borrow, let's call it $400,000. You're going to look at, and this will be part of literally the course I'm doing on Friday on refinancing, is you're going to look at the cost of the refinance versus the benefit. And lender fees, title fees, all the fees that show up on that statement. I'll teach folks how to read that on Friday. Put that on one side and call it $3,000. If your savings on a monthly basis is, let's call it $200, then 3,000 divided by 200, that's a 15-month break even. That's probably a deal that you want to proceed with. If you've got less than a 3-year break even and you plan to stay in that house for a long period of time, I think it's something that you move forward with. Determining how you're going to get a $200 savings is going to be a function of how much you borrowed and at what rate and what the new rate is. Some people say, oh, it's got to be at least a 1% difference in rate for it to make sense. Well, not really. A 1% difference in rate, if you owe $80,000, I wouldn't do it. 0.5%, if you got $1 million loan, I'd do it all day. You'll save $5,000 a year. So really, it's that. It's the cost versus benefit. How much are you going to save per month, and how much does it cost? Holy moly, it's raining in Sacramento. It is dumping out there. Dumping. Excuse me. We haven't got rain a little bit. It's good for us. Is Mara McKenzie at what time? I'm guessing you're talking about the financial literacy stuff. Different times every day. There's different stuff going on. So if you go register, there's going to be all kinds of stuff. My specific segment is 2 p.m. Pacific Standard Time, 5 o'clock Eastern for refinancing. But there's different courses every day. Go in there and register. Get yourself access to all of them. It's all free. All good stuff. All right, flash of light. 2.25% existing first mortgage, 6% fixed personal loan for 5 years to renovate versus HELOC home equity loan credit card. I'd probably take that 6% fixed if it was me. Those home equity lines, you're going to see 5 rate increases. And the Fed funds rate, those increases are directly correlated to all the indices that home equity lines are tied to, right? So you might get a HELOC that starts at 4 that ends up at 7 real quick. The 4 is usually the introductory rate anyway. It usually goes to 5 relatively quickly. So you want to take the fixed rate, I think, especially right now, where you're going to see interest rates rise quick on stuff like that. Wow. This is good stuff, Joey. I like hearing this, man. I know your mom's a realtor out there in Oklahoma. Listed a home at $395,000. They got cash offer just above asking the first day it was listed. No other offers. 50 people go through it in just one offer. Wow. Maybe the offer slowdown is beginning. Let's hope, right? That's the hope for every buyer I'm working with. It gets easier this spring. How's inventory doing in that market? I'm curious, Joey. Has there been more stuff come to market? We've seen a little tick up in inventory, and I hope more is coming. So does my buddy Alex. He wants more inventory to come on the market as well. It's a great question, Alex. And it's funny because I was going to repost my buddy Sam Parker, who owns My Credit Guy, did a great thing on mortgage credit pools, how little they affect your credit score. So if you're doing all the same spending and credit and you have same debt utilization, your score should not see much of a change at all. Like he says, 3 points tops. So, we wouldn't have to re-pull credit for probably 90 days. We could keep your pre-approval fresh by just updating documents. And then since the lender is going to eventually want an updated credit report, we'll go ahead and re-pull it, as needed every 75 days, maybe 90 days. Sometimes people are like curious, hey, I think my credit score might've gone up. Can you re-pull it when you freshen my pre-approval? Certainly. But, we're in a market where these pre-approvals are lasting longer than ever. I saw a stat somewhere that said 250 days for interested buyer to closed home loan, which seems like a long time. Hopefully that's not discouraging anybody, but it's no longer, I want to get pre-approved. Here's your pre-approval Wednesday. Look at a house Friday, offer Saturday, in contract Sunday, submit the loan the following Monday. Man, oh man, those are the glory days for mortgage folks, right? Like we could do that little bit of work. Now it's like pre-approved, looking at scenarios, putting in an offer. We're calling the list side. No thanks, we're close. Reconvene, re-strategize, new offer, and then might go on for a few months. It's unfortunately just the reality. So, yeah, I don't sweat getting your credit pulled for a mortgage pull. As long as you're not out there like running it at Best Buy, running it at a car dealership, running it, for multiple things. Even like fairly active dude that I am, I think when I looked, I had like 12 or 14 credit pulls in the last 12 months. My credit score is still at 790. Debt utilization is low. Pay all my shit on time. And I'm still 790. Plenty of mortgage pulls, right? Because when deals pop up, you got to be ready. Yeah, come check out that refi course. Happy to have you. And I'm going to put together some stuff this week to make sure I add value. I want to show people how to read a loan estimate. There are a lot of bad actors right now. Unfortunately, I hate to say it, that are preying on people. I literally talk to folks that work in data analytics on mortgage payoffs, and they tell me, Matt, if you look at the cash out refinance that's going on from 680 credit score and down, it's Rocket Mortgage by a landslide writing these loans. How can that be that they write all of them? Obviously targeting people with credit that's not as good. We're in an interest rate environment where sub 680 credit score, I promise you a cash out refinance rate is in the mid fives. If those people were in a 3% or a 3.5% or even a 4%, and you're putting them in a 5.5%, there better be a very good reason. I'm here to tell you, most people don't have a very good reason, except for the okay, 300 more per month, but I'll get 30 grand today. Sounds good. And if some guy on the other side has sales scripts where he can talk you into, well, it makes sense because if you pay off this credit card, you do that, blended rate this, and this and that. Trust me, I talk to these people. I listen when they call me and try to sell me on a refi. It doesn't make sense. It's disgusting. I'll teach you how to avoid that crap. I was wondering where the heck I was going and where I even started. That was that. Ryan Lundquist. You never have any questions. I got questions for you, though. I haven't looked at inventory stats for Sacramento. I think we've got some more inventory just by my feel. Tell me I'm right, brother. And thanks for stopping by. I mentioned you earlier. Don't know if you missed it, but SacramentoAppraisalBlog.com. I'll shout you out. Giving you credit. SacramentoAppraisalBlog.com. Ryan Lundquist. The man, the myth, the legend. Man, am I lagging on the other end, or is it just me and my computer? It takes like 30 seconds for things to show up. I feel like I'm on AOL dial-up over here. Someone Venmo me or gift me or something so I can afford some faster internet. Refinance volume is down. Mortgage folks are hurting. I can't even get high-speed internet. I hope more inventory is coming. It's interesting that Oklahoma won one offer. What were they seeing before? I'm interested, Joey. Were they seeing 3, 5, 8 offers per home? Was this a house that she expected to see 5 or 6 offers and got one? That stuff kind of matters. Did it go from wild to tame, or to go from just semi-wild, semi-tame? At least she got an offer at list or above it, cash as well. So that's good. All right. I'm not saying it. I'm just the deliverer. Can you guys hear that? That's thunder, Sacramento. Stay away from Rocket Mortgage. Will not give you the best deal. Call reps. Don't know what they're talking about. Go to Matt or You Mortgage or a great local mortgage broker you trust. That's well said. That's well said, Joey. It's not just me, or another one you trust. Probably me. All right. Still low inventory. I wish my computer was working faster. But really low compared to normal. I read something today, Ryan, about, 1.5 million homes on the market monthly by 2024 was Zillow's prediction. Somebody else said by next year we'd see that, like pre-pandemic inventory levels. Are we going to see them next year? We're going to have to wait till 2024. That's the $1 million question. I don't know if you know the answer. I certainly don't. Oh man, Ryan, I feel you on this, man. Like everything's more expensive. Wooden fence up 45% from 6 months ago. So see, if real estate's up 10% in the last 6 months, it's a screaming deal compared to lumber. Yeah, we got thunder, we got rain. It's getting crazy. All right. Just to deliver. I'm not making these jokes. Don't cancel me. These rate increases slapped home buyers like Will Smith did to Chris Rock. It's a good one. I thought we'd get through this whole hour without any of that meme stuff that's flooding the internet today. Holy moly, Canis. Did you get a 1.89? Is that on a 15-year? Back when rates were smoking? That is pretty darn good. All right, I got a couple more answers in me. A 30? You paid for that? For sure. Let's call it 4.95-ish, Simon. That's like a nationwide average right now for a 30-year fixed. Bravo guy, would you recommend a 5-1 ARM, then refinancing into a 30-year fixed? I mean, it depends on. A lot of smart people are thinking that interest rates will be lower than they are currently sometime in the next 5 years. So this could be a plan. You have to be prepared to be in this thing for 5 years and it adjusting after that point, right? Like, one, you got to be able to qualify to refinance out of this ARM. 2, rates may not be lower in the future, right? So there's added risk to an ARM, but some people are willing to take that risk. All right. I'm running out of steam, guys. I truly appreciate everybody who logged in. Let me know if there's anything you want me to address in future videos. Shoot me messages on YouTube. Shoot me messages to matt@mtmg.com. Let me know how we can help. As I've said, and I'll leave up here for the end, if you're looking to get pre-approved, if you want us to look at a refinance scenario that you've got, let you know our honest advice. Go to greatmortgagebroker.com. Fill out the quick form. Just let us know where you're at, how we can help. We're more than happy to. Come on, internets. Move faster. Greatmortgagebroker.com. Fill out the form. We're happy to help. Until next time, we gonna see. End the broadcast.